Live from New York City this morning. Good morning, good morning. Let's get March started. Equity futures negative 0.25% on the S&P. With about 30 minutes to go, the countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York coming up, looking for a bounce following a month of losses. China showing signs of a stronger rebound and inflation in Germany coming in hot. We begin with the big issue. New month, same problems.
Got a lot of big hurdles to clear.
We're in a very abnormal situation right now.
The economy does look hot.
A bit too hot to ignore.
We still have a high inflation environment.
A lot of volatility in this market.
A positive correlation between rates and stocks, which we usually don't see.
We are due for a recession.
Eventually, we know the Fed is already slowing and they will come to a halt.
But I don't think you fight the Fed here.
The equity market is coming to terms with the fact that the job is not done for the Fed.
They have told you over and over again they're going to be higher for longer.
What they're looking for is more balance in the economy.
And the market just doesn't believe the Fed, and every time we get a piece of data, good or bad, we're going to swing a lot.
I would not rule out a return back to the lows.
Joining us now to discuss SocGen, Subhadra Rajappa, Citi, Stuart Kaiser. To the both of you, thanks for being with us. About 30 minutes away from that opening bell, with equity futures rolling over just a little bit, and Subhadra, a lift in bond yields off the back of hot German inflation. Subhadra, it was Germany, it was Spain, it was France, it's Europe, it's the United States. What's left?
Not a whole lot. I mean, we're expecting, at least a little bit of a bounce in inflation because of the fact that there was some, adjustments to the baskets. But this has definitely exceeded everybody's expectations. Germany, Spain, as well as in France, in the U.S. as well. We've seen, very, very hot CPI prints. So broadly speaking, I think that the trajectory for year end is going to be a lot higher. I mean, our European economists are perhaps expecting, core inflation for Europe to be around 4%, at the end of the year. So and for as far as policy is concerned, we were on the high end. Our European economists were calling for the ECB to raise rates to 3.75. The market's now pricing in 4%. So there's clearly a push globally in global bond yields that's also supporting higher yields in the U.S. But again, the U.S. seems to be lagging because we're near the end of the cycle here on rate hikes. So it's a question of when the Fed is going to pause, not if.
So, Subhadra, based on what we've priced for peak rates in this hiking cycle at both the ECB and the Federal Reserve, close to 4 at the ECB, 550 plus maybe at the Federal Reserve, is one more achievable than the other?
It's hard to know. I think we are very, very efficiently priced in, if you will, for both in the U.S. as well as in Europe, for a path towards higher yields, and also for a huge policy adjustment. The real risk right now is that if the data disappoints in the next month, then the risk to us feel like it's more asymmetrically skewed towards lower yields and perhaps a miss in the market's expectations for rate hikes in the U.S. as well as in Europe. But broadly speaking, I think the momentum, coming from the fourth quarter, you're looking at first quarter GDP in the U.S. tracking, quite strongly. So in this sort of context, at least over the near term, the market's willing to give into the data and start to price in more hikes from both the Fed as well as the ECB.
3.95 right now on a 10-year in America, on a Treasury up 3 basis points, on a 2-year up 2 basis points to 4.83. Stuart, we've got to talk about what this means for equities. And you put out a note over the weekend coming into this week, and ultimately, just bad apparently. You wrote this. Basically, there is no consensus on the current regime. There is, however, a tendency to read all moves in rates negatively. Higher rates means growing inflation risk. Lower rates point to hard landing outcomes. Stuart, when does this start to look good again?
Good morning, Jonathan. That's a great question. I think good from an equity perspective would just be clarity, frankly, and that's going to take an accumulation of data probably over the next kind of 3 to 6 months to get a sense of, is growth or is inflation driving rates, and then equities can kind of respond to that if that makes sense. if yields are rising because the growth outlook is improving, I think that's, ultimately a net positive for equities. If yields are rising because inflation risks are kind of getting away from the Fed a little bit, obviously that's the opposite outcome. And that's why I think the market is or equity investors are sort of in a holding pattern to some degree, because we just don't have enough information to make that call yet. And as I mentioned over the weekend, I think people are just deciding to take the negative view regardless at this point.
One thing you have said, though, Stu, if we get any upside risk, it's led by growth equities. Why is that?
Look, our view on growth equities is basically the pressure on yields has eased a bit. When we had yields rise last year, the impact on growth equities was to severely derate their valuation. So we think, sitting here today, you've got a part of the market that's a large share of market cap. We believe it's underowned from both, institutional as well as retail and, fundamental as well as systematic investors. And for that reason, we just think path of least resistance is to the upside. You've sort of already done the hard work on the valuation side. A lot of those companies have started to, take efforts to kind of cut costs and protect margins. And if you take that together, we just think risk reward kind of skews positive. Valuations, rebased, and in our view, it's an underowned part of the market.
The month of January compared to the month of February was so different. In January, we were all talking about the disinflationary process. Chairman Powell came out in a news conference in early February and said, it started. President Lagarde was talking up risks becoming more balanced. January, we ripped. February, we retraced some of that. Year to date, these are the scores at the moment year to date. The NASDAQ is still up by about 9.5%. The S&P 500 is still up about 3.4%. The year to date moves. On this story is Kaylee Light. Say, Kaylee.
John, well, it's only the first day of March, but it's looking like it may be more of the same from February, in that after earlier gains, futures have now rolled over. We're down about 0.3% on S&P 500 and NASDAQ 100 futures. And once again, you are seeing upward pressure on bond yields. So more like February than January, because as you said, John, January stocks were ripping up more than 6% on the S&P 500. We have bond yields coming lower. It was kind of an everything rally. The story very different in the month of February, with stocks giving back some of those gains, bonds giving back gains as well. The S&P 500 falling 2.6% last month, while we saw the 2-year Treasury yield climb 61 basis points on the month. Of course, this is a story of a repricing of expectations of a higher for longer Federal Reserve. The economic data leading the market to reprice higher the expectations of the terminal rate and begin pricing out the odds of the Fed cutting by the end of this year. So there really weren't that many places to hide last month. You couldn't do it in high yield credit, which also was down in February. You couldn't really do it in any single sector in the S&P 500. Every sector in the index was down on the month last month. The one that was the least worst performer, if that is the proper way of saying that, was technology. And this actually comes back to the year-to-date theme, which is what you and Stuart were just talking about. Growth stocks, tech-heavy sectors have been the ones outperforming. Consumer discretionary up more than 12%. Of course, that is largely Tesla, which has nearly doubled since its low in early January. You also have tech and communication services, which is tech-heavy, rallying as well, even though we have seen upward pressure on yields at the short end of the curve, John.
Kelly, thanks for that. We'll catch up with you a little bit later this hour. Showed a graphic there of what happened in the month of February. Let's get that back up again. Look at the 2-year move we saw on the month, 61 basis points. If you actually go off the intraday low of the month, which was February 2nd, 4.03% out to 480, that is an 80 basis point move on a US 2-year from the lows of the month. Now, Stuart, I remember when we were talking up 3% breaking things, 4% breaking things. Now we're talking up 5 and 6. Stuart, what does break things?
Geez, I wish I had that answer. Look, I think the reason these yields haven't kind of broke things yet at these levels, frankly, is one, the growth data has held in fairly well, right? So you're not in a situation where yields are rising to fight the inflation problem, and you also have a coincident sort of falling apart of the U.S. economy. So I think that's one thing that's probably been a bit of a salve to this issue. And the second, frankly, is what are you going to do, right? I mean, yields are higher. This is the investment environment we're living in. So what people are doing is they're trying to find the stocks and the areas of the market that can work in that investment environment, right? People need to be invested. So essentially, you're just solving. You're saying if yields are where they are and if they're going to continue to rise, then what can I own? And that's ultimately what I'm going to own. And unfortunately, that's also meant we're going to own a lot less, right? So I think the fact that people are in a lot of short-term and cash similar assets is probably another reason equities have held them pretty well, because there's just not as much equity to sell as there has been in recent years.
So Badger, I think we can apply this one to Europe as well. If you'd asked me 12 months ago, asked anyone 12 months ago, could the ECB get to 3? They would have laughed. Get to 4? No chance. And here we are staring down the barrel of the prospect of just that happening. In Italy at the moment, the 2-year is at about 370. The 10-year is at about 455. So Badger, is there a moment where that starts to become a problem, a bigger problem?
Oh, absolutely. I think that the transmission mechanism, if you will, in the U.S. is somewhat a little bit more broken. You need to see much tighter financial conditions for Fed policy to feed through to the broader economy. But in the U.S. and in in Europe and in other countries, interest rates are much more closely linked to the broader economy, if you will. If credit spreads start to widen, you're going to see QT coming in from the ECB. That could pressure perhaps BTP bond spreads wider. Credit markets could come under a little bit of pressure. The question really for the ECB is that if the pace that they're starting off with, which is 15 billion, are they going to have to ramp it up even more to have the desired impact, if you will, of the transmission of monetary policy? So the way monetary policy is transmitted in different regions is quite different. And in some respects, it feels like, at least in the U.S., that monetary policy is an extraordinarily blunt tool. And you really need to see a tightening of financial conditions for the Fed and monetary policy to be somewhat effective in the U.S.
Just to build on that a little bit more, what happened in September in the gilt market, I understand is very, very unique to what happened in the UK. But Subhadra, do you think that was maybe just a little bit of a test of what we could face somewhere else later this year?
It's possible. I think we have learned from what happened in the UK market. I think that other markets and the asset liability managers are in a very different place than the UK gilt market, where the move was pretty dramatic and unexpected, and the managers were not ready to handle that very large move. The repricing that's happened in the last month or so has been very gradual. So in an environment like this, I think that global bond yields will fare okay. I think the sharp moves higher is when you tend to see what you saw back in last year in the gilt market.
Subhadra, Stuart, sticking with us, I'm pleased to say, about 20 minutes away from that opening bow. Futures rolling over just a touch. We're down about 1/3 of 1%. We can get you some movers. Here's Abby.
Hey, John. Well, we have some outside laggards to take a look at, starting off with the shares of Novavax. If there are 3 concerns that investors do not want to hear, going concern risk, and that's exactly the deal with Novavax. They express substantial doubt about its ability to stay in business through the next year, this year. They've been challenged to sell their COVID vaccine. The smallest of the problems, perhaps, is the fourth quarter sales miss. Not surprisingly, price targets cut on the street. As an example, B. Riley cutting their price target to $10 from $29. Rivian also down sharply, down 8.6%. Their fiscal year view of as much as 50,000 vehicles to be delivered. Well, it's not enough. The revenue missed as well. Lots of street price targets cut there also. And then finally, if we haven't had enough downside movement so far, Kohl's, a department store, down 7.3%. They put up a simply awful quarter, a loss of nearly $2.50 versus the estimate of it up $1. The 5% sales missed by 5%. Comp sales down 6.6%. Price targets cut there. Ugly, ugly, and ugly.
And someone earlier today called it a glorified Amazon return center, or something like that. Brutal. Abby, thank you. Futures down just a little bit. Coming up, China's rebound starting off strong.
The recovery in China, the recovery this time is likely to be different from previous recoveries.
That conversation up next.
We expect it to be stronger, but not this strong.
The recovery in China, it should mean that we see an end to the supply side disruption.
It also creates a lot of uncertainty around inflation.
The recovery this time is likely to be different from previous recoveries.
The probability of volatility increasing is growing as we see this huge economy really start gaining traction, whilst the other huge economy on the other side of the world is really trying to slow things down.
Strong data out of China as the economy reopens. Manufacturing activity topping decade highs, leaving officials pleasantly surprised. Bloomberg reporting Chinese leaders are, quote, satisfied with the economic rebound and the need for stimulus is moderate for now. For more, let's get to Mike McKee. Morning, Mike.
Good morning, John. Well, you saw the numbers there. They are good news about the Chinese economic rebound. But the question is not, did they rebound after the Lunar New Year? The question is, does it continue to keep going? Chinese are starting their National People's Congress on Sunday, and that is when the leaders are expected to set a new growth target. And it looks now like it's going to be revised higher because of some of this data that has just come in, perhaps above the 5% rate that they had previously established. What you have to look at, though, is where that growth is going to come from. Trade exports have been falling. Imports to the United States negative for the past 3 months. And also, we're looking at a drop in retail sales. The hope was that there would be a big rebound in retail sales once people were freed from the no COVID policy. But so far, that hasn't happened. We'll be watching for that data as well. And then a third part here, this is really interesting. The American Chamber of Commerce in China released a new survey of all of the U.S. companies who are doing business in China. And for the first time ever, China is not in the top 3 of the businesses, places to invest in the world. It's 14%, the first priority, only 31% for the top 3, and 38% say it is just one of many places to invest. So the world is changing on China. Can China's economy change to keep up with the world?
It's changing fast. Mike McKee, thanks for that. The latest data out of China looking better. The politics getting trickier. President Xi welcoming President Lukashenko of Belarus, a Russian ally. President Xi telling his guests, quote, China's stance on the Ukraine crisis has been consistent and clear. We must stick to the direction of resolving the issue through political means, abandoning the Cold War mindset. AMH joins us now in Washington. Morning, Anne-Marie.
Good morning, John. Well, Xi Jinping on display trying to be this global statesman, but really this is an olive branch to President Putin. I think U.S. administration officials really just see this as an expansion of their quote-unquote no-limits relationship they talked about last year. This year, when Wang Yi was in Moscow, he talked about the Moscow-Beijing relationship being solid as a rock, and now a staunch Putin ally. This isn't just an individual who has a ton of trade with Russia. This is someone that allowed Russia to amass troops in Belarus before that invasion took place about 1 year ago today. So this is Xi Jinping. An olive branch to Lukashenko is really one and the same as an olive branch to President Vladimir Putin.
What a messy time. AMH, thank you. Great work down in Washington. Anne-Marie Hordern there. Back with us for final thoughts. Sabadra Japa, Stuart Kaiser. Sabadra, we're still trying to figure out what this reopening of China ultimately means for the rest of the world, for the global economy, for markets, for fixed income. What does it mean for you?
For the most part, China coming back online is a huge positive for the global economy. We're going to have the National Party Congress meeting on March 5th. They'll probably try their best to support the recovery that's currently underway and undo some of the bad sentiment that got priced in because of the zero COVID policies. I think for the most part, you're looking at maybe 5 to 5.5% growth for China. This year, you're starting to see mobility rates in China start to rise quite dramatically. But as Mike pointed out, exports are still lagging. Really, the growth, the engine of growth for China is infrastructure, spending, property, as well as exports. And all of these 3 sectors are still lagging quite meaningfully. So we're going to need to see more stimulative policies come from China to support the economy. And I think that that's going to have a positive impact on global growth.
If we get that, Stuart, you've got the Fed and the ECB slamming the brakes, both at the same time, and a tailwind coming out of China. How does that work?
That's a great question. I mean, I agree with the view that, China reopening is kind of a positive global growth impulse. I think you would argue that that kind of just raises the floor for global growth, which is, a net positive for risk assets. You might argue it creates, or it makes the problem a little more difficult for, for the ECB and the FOMC because, they're trying to slow growth at a time when China is reopening. But look, I think if you're an equity investor and you have China reopening in the background and that does put a bit of a a support under the global growth story, I think that's a net positive. The trick from an investment perspective is, the political and the geopolitical stuff just makes it very hard to invest in this story. And, frankly, I think it means that investors are looking for China derivatives, things like, let's say, European luxury goods, as opposed to investing in China directly. It kind of turns the China it keeps the China trade a trade as opposed to an investment, I think, for most U.S. investors.
Stuart, would you suggest the same thing then? Play the proxies, don't go direct because of the political tension?
Yeah, I mean, I think that's generally what we've been more comfortable with, whether that's, European luxury, industrials like the DAX that, have a high exposure, into China. That's generally how we've guided people, or actually, to be completely honest, is how people have guided us, right? It's I like the China story, but I'm uncomfortable maybe owning China direct. What are some other alternatives for me to get that beta into my portfolio without, getting trapped in a geopolitical kind of beehive?
Subhadra, can I finish on that with you? Do you think the ECB likes the China story, just from the perspective that they're trying to get inflation down and maybe soften growth a little bit?
At this point, they're very much focused on inflation. I mean, the prints are extraordinarily hot. It's really hard to see what the second-order effect would be from China, getting its back and rebounding in a meaningful way, having an impact on global growth. I think all central banks are going to be very much focused on just inflation. So, for the most part, the way we look at the markets, I feel like there's still a little bit more room for bond yields to continue to rise relative to treasury yields, and for the ECB to really catch up, if you will, to global central banks. So this asynchronous growth environment is going to persist. It's really hard to know what feeds through and what doesn't. So the focus is going to be much more domestically led towards, domestic inflation and trying to find ways to cap inflation, if you will.
Subhadra, super quick. When you look at what we're talking about with the ECB and the Fed, the ECB may be going to 4, the Fed perhaps pushing 6. Can I just go back to a question I asked a little bit earlier? Is there more chance the ECB gets to 4 than the Federal Reserve getting to 6?
That's a very good question and a hard one to answer, because typically the market is, especially in Europe, tends to overprice hikes and underdeliver. So, again, given the asynchronous, global growth environment, as the U.S. starts to slow down meaningfully, I think it's going to be very hard for the ECB to deliver a 4%, policy rate at the end of the year. So, for the most part, I think you're going to be following each other, just with a little bit of a lag.
Subhadra, thanks for that. Subhadra Japa, Stuart Kaiser, to the both of you, thank you. Up next, your morning calls. Three seconds away from the opening bell this morning. Good morning to you. The official market start for the month of March, just around the corner. Equity futures down by 1/3% on the S&P. On the Nasdaq, we're down about 0.2%, adding to the losses through the month of February. The opening bell in New York rings. Switch at the board and get to the bond market. A lift in yields once again, up by 4 basis points. Having another look at 4%. Your 10-year 395.72 at 4 basis points on a session. Inflation in Europe heading in the wrong direction, higher. In France, in Spain, in Germany, yields up, the euro stronger. Euro dollar 106.73, coming close to 107 again, positive 0.9% on that currency pair. And crude lower, negative down, softer by 0.5%, 76.70 on WTI. About 20 seconds into the session, we're a bit softer on the S&P. We're down 0.2% on the Nasdaq. We're virtually unchanged. One stock to watch at the open, Rivian. The company delivering a disappointing outlook and writing in a letter to shareholders, we encountered multiple days of lost production due to supply shortages. We expect these supply challenges to persist into 23. Ed Ludlow on the West Coast with more. Morning, Ed.
Yeah, good morning, Jonathan. Down 10% on the stock, biggest drop since November, a 2 standard deviations move. And if you look at consensus, actually hopes were really high. Many analysts were saying that they hoped Rivian would say we'll build above 60,000 units. Evercore ISI out with a note that basically points out, based on last year's conversion rate, if Rivian says it's going to build 50,000 EVs, it's unlikely to deliver anywhere near 45,000 of those. They also all point to the balance sheet, right? $12 billion left in cash, cash equibs, and restricted cash. But based on the cash burn rate, that would be halved by the end of this year, raising questions about this company, which in November 2021 had the 6th biggest US listing in history, needing to raise even more capital. You can see there its declines across 2022, the second worst performer on the NASDAQ 100. If there's a bright spot, John, and the analysts do note this, it's the belt tightening has worked. They reported an adjusted loss of $5.2 billion for last year, slightly below the guided $5.45 billion. And for this year, it will be an adjusted loss, excluding some items, of $4.3 billion. This is a company I know really well. The interest in it is still super high because of who's backing it. And they are still leagues ahead from your Lucids and your Nikolas. But the street really left disappointed here.
Doesn't like the stock this morning, that's for sure. Ed, thanks for that. The stock's down by about 9%. Talked about Dan Ives then of Wedbush. This is what Dan had to say following these results on Rivian. On the one hand, Rivian is making progress and will learn from their manufacturing issues. However, time is ticking and the cash burn situation puts more pressure on the 24-25 timelines. More capital raises are not out of the question to get Rivian through this next phase of their build-out and growth. That stock is getting slammed by close to 10%. Want to stick with earnings. Coles following suit with a downbeat forecast. The CEO saying the results reflect, quote, sales pressure driven by the ongoing persistent inflationary environment. Abby has more. Hey, Abby.
Hey, John. Well, the stock, interestingly, is well off of its lows right now, down about 2.7%. Earlier in the pre-market, down far more than that. In fact, down for a 5th day in a row. Over that time period, about 10%. It was a simply awful quarter. Inflation being blamed, as you just mentioned, but a massive, massive profit miss. A loss of $2.49 versus the estimate for a gain of $1, a 5% sales miss, comps of down 6.6% missed as well. And the outlook, it was absolutely decimated. The fiscal year profit view of $2.10 to $2.70 misses the estimate of $3.20 by as much as 30%. Gross margins of 23% missed. All of this also due to markdowns and discounting. Inventory is a little bit better. That was really the only bright spot. Not surprisingly, we have some weight here on the overall sector, the retailing sector. Macy's and Nordstrom, good comps, also down. As for Kohl's, well, this is not their first bout with trouble. This is a chart from the peak of 2018, and you can see it's down 66%. They've got their work cut out for them, and it seems as investors don't necessarily believe that they're going to succeed, John.
Abby, thanks for that. Sticking with retailers, Lowe's delivering a tepid outlook and striking a cautious tone. Following the likes of Walmart and Target, the CEO seeing a consumer more concerned with recessionary risk. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, shares have been waffling between gains and losses in pre-market trading, but now as the bell rings, it seems like we're making a decisive move lower in Lowe's shares, currently off about 1.6% after reporting a pretty mixed bag. So let's get specific on some of those numbers. You did have revenue come in a bit light. It was a touch under $22.5 billion last quarter. The estimate there was for $22.7 billion. Adjusted EPS was actually a beat, but then you look at those same store sales. That was a disappointment, falling 1.5% versus expectations for a slight gain in the fourth quarter. What matters here, though, as you touched on, John, is that cautious guidance going forward. You have Lowe's forecasting a sales contraction this fiscal year after, as you can see, a massive boom in 2021. And this is the pandemic story that we've seen play out over and over again. You had growth pulled forward in a big way, and those companies paying the price now. So you're looking at analyst estimates there, and the consensus is that 2024 will be painful as well before a slight recovery in 2025.
Katie, thanks for that. The stock's down by about 2.3%, about 5 minutes into the session. The broader market looks like this, down about 0.25% on the S&P, on the NASDAQ, down about 0.25% as well. Wall Street closing out a weak February. Morgan Stanley's Mike Wilson calling March a risky month. The equity market may have one last stand before we fully price the earnings downside. We think interest rates and the US dollar both need to fall for this stand to have a chance. With the market showing signs of exhaustion, March is a high-risk month. Mike, I'm pleased to say, joins us right now. Mike, great to have you with us, as always, sir. Let's start with that question. Just why is March so high risk for you?
Well, good morning, John. Yeah, I mean, normally March can be both seasonally positive or negative, but what we're seeing is this pattern over the last year where, we're in an earnings downtrend. And there's a presumption now, I think, by the market that because the economic data has been a little bit better than expected, including what we were expecting, that the earnings declines are now over. And that's not what we think. And the way the market's been trading over the last 3 or 4 quarters is, the market figures it out the month before earnings because the word kind of gets out that maybe things aren't so great in that last calendar month. And then, of course, when the companies report and the numbers actually come down, the stocks have kind of relief rally, thinking, okay, the worst is behind us. But it's been kind of this, repetitive pattern. So if that pattern holds, then March should be the month where the first quarter earnings get digested. Even though the revisions aren't coming down yet, the market gets ahead of it by about a month.
Mike, there is a concept that I hear you use and see in your research repeatedly. It's negative operating leverage. Now, Mike, for people who aren't in the equity market like you are, don't follow this stuff like maybe other people do, what does that concept mean and why is it so important right now?
I mean, it's a very simple concept. Anybody who's been doing this, for any period of time understands it, which is that, when you get positive, well, operating leverage is basically the leverage the company's earnings have to revenue growth. And so in the pandemic, of course, we had incredible positive operating leverage because costs were slow to come back as people were stuck at home, but the revenues came roaring back as we digitized the economy and we were able to operate. So we had this windfall profit. And we think that windfall profit was very broad. It wasn't just a few companies benefiting from COVID. It was all over the economy. And as you know, John, we've been talking about this for a while. And now, of course, we have evidence that that operating leverage is going negative, meaning we're seeing a deterioration in revenue growth, but then we're getting a much more severe decline in the earnings. And we just saw a couple of companies you mentioned in the retail space where that is being played out in spades. And that is going to happen across the economy. The evidence is already overwhelming. It's been most apparent in the tech space because that's where the overinvestment was the most egregious. And now we're seeing companies deal with that, but we think they're going to be woefully slow to get those costs down to a level where we think they need to get the margins to stabilize. So that's the thesis. It's playing out. I think some people think the worst is behind us. We think the worst is still probably ahead for most companies.
Mike, given what you've just said, from your perspective, does that mean the economy overall can be okay, but the equity market can look pretty dreadful?
That's exactly right, and that's why we have this view in our house view is that we don't expect a recession this year. I mean, we expect slower growth for sure. Close to zero real growth, but the earnings story is much worse than that. So we have this sort of weird setup where the economy looks okay, but the earnings look terrible. And by the way, it's no different than what we saw in 2020 and 21, where the economy was just starting to recover, but the earnings were explosive. So we identified that early in the recovery back in April of 2020. We said there was going to be a very explosive operating leverage story to the upside, and even we underestimated just how powerful that was. So what I'm a little bit worried about, to be honest, John, is that we might be even underestimating how bad the negative operating leverage could be. So we'll have to wait and see how it goes. But what we're very confident saying is that the margin pressure that we see has not been fully discounted in the earnings yet.
So, Mike, you clearly don't think October's the low. I won't ask for a pinpoint number, but I'm sure you can give me a range. What kind of range are you thinking about?
Well, the range isn't so important to us, John. It's more about, what happens with earnings? Okay, so if earnings come down, and we've talked about this before, if earnings come down in a way that we think is appropriate with the path that we see, and we don't get a reset on price, then we'll just say it's over, okay? So that could be here. That could be, down 5%. It could be down 20%. Our work suggests it's going to be down closer to 20% from here, so clear low 3,000s. We don't have a crystal ball, obviously, but what we can confidently say is that the equity risk premium and the multiples that are being reflected do not reflect the earnings risk that we see, and we think the reason why that's happening is twofold. Number one, the economy is better, and people were not thinking that 3 months ago. I would say the biggest shift in that regard is, 3 months ago, most institutional clients thought that a recession was very likely. Now they're thinking it's not so likely anymore. So that's a big, sea change. And then, of course, this liquidity picture that we've been writing about and talking about, where global money supply growth has been more than offsetting what the Fed has been trying to do with tightening financial conditions, and that has created sort of an ebullient environment for asset prices. That's not sustainable in our view. But the timing of that's been a little tricky.
Mike, I'm sure you get a ton of questions about the October low. Based on everything you've said, obviously we don't have a crystal ball. A lot of people would lean on market history, though. How rare would it be if October was the low?
Well, okay, let's assume a few things. Let's assume that our earnings forecast is more right than wrong, meaning that the forward estimates have not yet troughed. it would be somewhat unprecedented from a timing standpoint to, let's say that earnings trough sometime this summer or in the fall when we think. It would be unprecedented for the market to have bottomed that far in advance, okay? But of course, we could be wrong about our earnings forecast, right? We don't, that's another thing. We can't be, it's not infallible. But the odds are with us. The odds are, because our model is very much in gear. We have to go with the probabilities. And that's why we've been making the call we've been making, is that we just don't think the bear market is finished because the earnings recession is far from finished.
You said we could have one last stand. A lot of people might be gripping to that hope, Mike, that we could get another rally here. Mike, what would you need to see? And what's the chances that it's going to happen?
Yeah, well, look, I mean, we called the rally in the fall from October to December based on the following, based on the view that we thought China was going to be reopening, which it did. That would help global growth story, and rates were probably peaking, and they did. They came back down, but now that's sort of reversed, right? Rates are shooting back up because the Fed has more work to do on inflation. And I would argue the China story, I think some of your guests were just saying, we agree with this. This is a China story. This is not a global growth story. So yes, it's very good for China equities and maybe some Asian economies that can gear off of that, but not so much the U.S. stock market, which isn't that geared to China growth. So in order for the market, for valuations to go up further, which is what we're talking about, right? In order for stocks to go higher, it has to be valuation driven because the earnings are going to be flat at best in terms of the trajectory. That means interest rates have to come back down, and the dollar has to weaken again substantially, which it's been stronger here more recently as the Fed's been it's signaling they're going to tighten further. So without those two tailwinds, I think it's almost impossible to argue for higher valuations, which means it's very difficult to argue for higher stock prices.
Mike, fantastic to get your views, as always. And as always, enjoy the research that comes out on the weekend, often starting a new week with Mike Wilson of Morgan Stanley. Mike, thank you, sir. You brought a market down about 0.2% on the S&P. Happening right now, just getting some live pictures of President Biden appointing a new Labour secretary to replace Secretary Marty Walsh. Anne-Marie back with us down at the White House. Morning, Anne-Marie.
Good morning, John. That's right. President Biden today is going to be nominating Julie Su. She's the deputy labor secretary. Of course, Marty Walsh is leaving. He's going to go over to the NHL. So Biden wants to nominate this individual. She is really embraced by progressives and Democrats in the party who look at what she's done early on in her career in terms of worker protection rights, and then as well in California. But we should note this, of course, has to get confirmed at the Senate. The Democrats have control of the Senate. But when she was confirmed for her prior role, when she was deputy, it was really along party line votes. And already you're hearing from some congressional Republicans who say that her policies are, quote, destructive when it comes to the gig economy. But given that she was able to get nominated with the Democrats holding the majority in 2021, she's likely going to be seen as the next labor secretary under this administration.
MH, thanks for that. The latest with the president and his cabinet. Coming up on the program, Goldman's Investor Day. Their pitch falling flat.
In those consumer platforms, we have a plan to drive to profitability. We told our investors today we would drive to profitability in 2025.
That conversation up next.
This is Bloomberg The Open. I'm Lisa Mateo, live in the principal room. Coming up, Coinbase CEO Brian Armstrong. That conversation at 10:30 a.m. Eastern, 3:30 p.m. in London. This is Bloomberg.
In those consumer platforms, we have a plan to drive to profitability. We told our investors today we would drive to profitability in 2025. We likewise said that we will look at and explore and are exploring strategic alternatives to make sure that we understand all opportunities in front of us to unlock value in platform solutions.
Goldman Sachs holding its second annual Investor Day, the bank focusing on restoring confidence with a glossy portrait of its prospects. Investors not buying it. The unclear messaging around its consumer unit sending the stock lower. RBC's Jared Cassidy saying it's, quote, an albatross around Goldman's neck. Shanali Basak was there. Hey, Shanali.
John, it's incredible. Even when you have analysts from Wells Fargo to Bank of America seeing Goldman on path to reach its longer-term targets here, this question around the consumer business is a near-term drag on the stock. They are exploring a wide range of options. Remember, one of those options we have reported could be a sale of Green Sky, which is a business that bought for more than $2 billion a couple of years ago, agreed to buy a couple of years ago. Now, remember, that is a business in this environment that has had the drag of pressures on the consumer. And the interesting thing here here, John, is so much about timing as well, because you're finally seeing, just as Goldman was the worst performer yesterday on the Dow, JP Morgan was the best performer. So you're finally seeing consumer stocks get some love back in the stock market, but a lot of questions about Goldman's execution of this business moving forward. At the end of the day, they are trying to draw out a new narrative. That is Goldman 2.0, this idea that Goldman is both an institutional securities business and is making big strides in its asset manager, but consumer is still a big question.
I've got to ask you, as the man that you spoke to, the future of this company?
There are certainly a lot of questions around that. Remember, David Solomon, he spoke for 10 minutes off the bat. John Waldron spoke for another 20 minutes off the bat. David took questions at the end. There were a lot of new faces, by the way, John, this time around compared to the 2020 Investor Day. So the second ranks of Goldman Sachs, they said turnover is at a 5-year low, but the second part of their ranks look very different.
Really interesting. Hey, Shanali, just wonderful work yesterday. Brilliant. Enjoyed following your coverage of it. Thank you. Shanali Basak there over at Goldman. Tesla's turn today. Elon Musk unveiling his latest plans for the EV maker and putting the stock's 70% rally to test. Ed Ludlow back with us for more. Ed, what are you looking out for today?
Well, first of all, John, the bar is very high. You look at that year-to-date stock performance, a number of analysts noting no matter what Elon Musk says and no matter how good he is at keeping investors looking to the horizon, it will take something pretty spectacular for this news to be continuing to support the stock. This is about the future over a long-term horizon, right? Tesla scaling manufacturing, but also thinking about its energy business as well. What I'm hearing from sources at Tesla is that there will be a big emphasis on supply chain. What does Tesla need to do to support that mass scaling of manufacturing on the base materials side of things? What is it doing in mining of the metals required for batteries? I remember coming on this program with you, Jonathan, 2 years ago and talking about a $25,000 Tesla for the masses, the everyday American, European, or markets in Asia. It was never forthcoming, but we do think that there will be some element of Elon Musk discussing that scaling and changing the economics of an electric vehicle's price tag so that it is more affordable for others. And of course, there's going to be an element of discussion about robo-taxi as well.
And Twitter might come up, maybe. And who knows? Ed, obviously. Ed, thank you. Looking forward to your coverage as well. Thank you, sir. Your broader equity market unchanged on the S&P, positive about 0.1% on the NASDAQ. We had some economic data out of the United States just moments ago. Mike McKee pouring over that. Morning, Mike.
Morning, John. Well, the question has been, will February come in weaker than the January numbers we got in a lot of data categories? And it looks like the first one out of the box does. The S&P manufacturing PMI for February comes in at 47.3. That's down from 47.8 for January, and that was the forecast as well. And it kind of fits with a pattern we're seeing around the world. We talked about China having a strong month, but the rest of Europe all coming in weaker for the month of February than the numbers in January. UK, the only outlier there. And then this raises questions about, at the top of the hour, the ISM and what we're going to get with that, whether we're going to see a drop or not. The forecast, John, is for a move up to 48 from 47.4. We'll see if we get that far.
It's the question we all want the answer to. Was January a one-off? Will February confirm? The ISM data 8 minutes away. Mike's going to be around to break that down. Mike, thank you. I believe we can squeeze in some sector price action. We can do that with Abby. Hey, Abby.
Hey, John. Well, we have barely a move here for the S&P 500, basically flat to the downside. A couple of sectors are up largely to the upside. Energy and materials to the downside, though, really catching my eye. Real estate and utilities down almost 1%. This as yields are higher. Those dividends look less attractive. What's so interesting, though, right now, John, coal has flipped to the upside. It's now up 3.6%. Let's take a look at the retailing sector on the year, because we're going to see a big move up earlier this year, up about 20% and then down about 12%. Net right now up 3.2%. I think investors trying to figure out what's going on. Telsey keeping its $35 price target in coals. Maybe that's a bit of the reversal that we have on the morning.
Abby, thank you. Thanks for that on the equity market and the sector price action. Abby mentioned the bond market, so let's pour through that one briefly. Up a couple of basis points at the front end on a 2-year, 4.84 on a 10-year. Keep coming close to 4, but not getting there. Your 10-year, 3.96, up 3 or 4 basis points. The 10-year, the high of the session, 3.96.11. Up next, your trading diary. Will the February economic data confirm the strength in January? In the short term, at least, I don't think anything else matters for this market. The data of the next 2 weeks is going to be really important. The next 2 or 3 weeks. Payrolls next Friday, not this Friday. Equities unchanged on the S&P, on the Nasdaq unchanged as well. About 26 minutes into the session, your bond market looks like this as well. That's equities. Here's fixed income. Yields up just a little bit by 2 basis points. Your 2-year, 483.68. That's the price action. Let's get to the trading diary. It's all about the February economic data. Look out for the ISM manufacturing number at the top of the hour. President Biden speaking again at noon Eastern. Look out for that too. Plus, Tesla's Investors Day is kicking off. Another round of claims and earnings from Macy's and Costco coming on Thursday. And finally, President Biden again, this time meeting with the German Chancellor Olaf Scholz at the White House on Friday. That gets you to the weekend. Before we get there, of course, a few more shows to go. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.